This is Edible EconoMIX, bringing you the important topics of our times as we turn noisy headlines into bite-sized issues you can actually digest. This program is for information only, not investment advice. Here's Andrew Tang.
Hello, everybody. Welcome to another episode of Edible EconoMIX. Today, I am blessed to have somebody who is as accomplished as Mr. Dean Smith himself. Now, he looks like a celebrity, but let me correct you. He is not from Hollywood. He is very much in the investment arena. And if I may, I'm just going to talk to you a little bit about Dean. So he has over 25 years experience in structured products, including mortgage-backed securities, and basically many different bond products. Okay, so he's a bond manager, fixed income. So for example, if you are investing, it's either, divided into stocks or bonds, and then Dean lives on the bond side, right? So right. That's where he's from. So he's also the current portfolio manager for FolioBeyond. That's an amazing company that I use two of their products. So one is the ticker by RISR. I call that the riser. And what it is, I use it as an interest rate hedge because most bonds and fixed income products, they tend to do well, that when interest rate tends to come down. But the RISR is very different. They tend to do well in all circumstances, especially when the yields are climbing. So I'll let him talk a little bit more about that. And then another ETF that I would say recently launched, within 3 years, that goes by the FIXP letters. So they call that FIXP or whatever. And to me, that's an all-weather tactical fixed income strategy. So it doesn't matter where interest rates are, basically they stay very tactical. Both yield, somewhere around 6 to 7%. RSR yields a little bit more. That's why I love it. And I use it, again, as a component to my particular bond model because I use several instruments in the bond model. Okay, so Dean, he is the founder of Stonehenge Financial Partners. This is back in the days, probably. Yeah. Was also the partner of Highland Financial Holdings, held senior positions at DLJ, Dowson, Lifskin, and Generate. And if you know what I'm talking about, your age is up there. And Nomura Securities. Also, he has a master and I would say almost PhD in economics from Columbia University and a bachelor's in economics from University of California in San Diego. So welcome, Dean.
Pleasure to be here.
Thank you. So 3 things we're going to talk about today, and I'm trying to not to be so long-winded. The first thing we're going to talk about, today's topic is going to be revolving all around interest rates, right? How it impacts us, causing a restrictive environment versus easing, right? So either you're restricting the economy by raising interest rates, by making the cost of capital high, or the Fed could be lowering interest rates so that it'll make borrowing much easier for households and businesses. So this first thing we'll talk about. The second thing we'll talk about is what's called the yield curve. And I'll let Dean talk about, explain what that is and, what we hear, from the media, mainstream media, the likes of CNBC and Bloomberg. They always talk about the yield curve. And then I'll let Dean to explain the significance of it and then what he has been seeing. And then thirdly, we will close with what are the real opportunities in bond investing right now with the setup that we currently have. We also have changing of the guards. Current Fed Chair Jerome Powell is leaving. Mr. Kevin Walsh is pretty much confirmed coming in. So we'll talk about those 3 things. So let's get started.
Great.
Okay, the first topic is, are interest rates really high right now, right? So when I look at the United States Fed funds rate, we're about 3.5% to 3.75, somewhere around there. They're in that range. But if I look at the 30-year fixed jumbo mortgage rate, it is still somewhere around 6.5%. Now, keep in mind that I want to remind the audience that the Federal Reserve sets the Fed funds rate, but most other rates are free flowing, right? Especially with the yield, it's free flowing and is a reflection of growth and inflation. blah, blah, blah. And the 30-year mortgage rates, it's really all about supply and demand and the interest rate landscape. But the mortgage companies, they're the one who's going to set these rates, right? And also, hey, your credit score is going to dictate the rate that you're
Right.
going to get as well. So, Dean, are we in a higher rate environment still, or what do you think?
Well, the short answer is no. Interest rates are not high by historical standards. There's a couple of different ways you can look at it. Sort of the key benchmark that I look at and most other market participants look at is the 10-year treasury rate. That's the rate that is used to set mortgage rates. That's the rate that is used for long-term corporate borrowing, plant and equipment, capital investment. Now, if you go back to 1962, which is as far back as you can go on the Bloomberg, the average yield for the 10-year treasury is 5.81%. Okay. Now, some people might object and say, well, you're including the Paul Volcker years when interest rates were really high. So let's take out 80 to 85. Okay. That leaves you with an average 10-year yield of 5.17. We're currently right around 4.4%. So we're well below the historical average for the 10-year benchmark yield. Interest rates only look high today if you have a very short memory. If your memory only goes back to the great financial crisis and the COVID, but if you take a longer term perspective, interest rates are not high. They're pretty much in line with historical norm.
Yeah, I have to agree with you because I have to remind the audience too, interest rates were set at artificially low levels because of the great financial crisis and the mortgage blow up era in 2008. Also, I like to remind everybody, I remember my father bought a Cadillac Seville in 1983, and that was the car of the times. And the interest rate to finance that car was 10%. Now, I fast forward to the Obama administration years and the Bill Clinton years, the interest rates were about 5%. And then you fast forward that to 2008, obviously, and that's when the Federal Reserve at that time stepped in and say, let's help out the economy. Let's lower the rates to artificial low levels to 2 and sub 2% level so that the economy could be rescued.
Yeah, the problem with that was not that they lowered rates after the financial crisis. That was a true financial crisis, and they had to respond aggressively. The problem is they left interest rates near zero for 7 years.
Yeah, it was like a drug that the economy got used to, and at the same time, money supply was quite high. So all that buildup, all that prolonged low rates did create a lot of growth. But then at the same time, it was just a matter of time for inflation to catch up. But that's another topic. We're not really going to talk more about that. Currently, I think we can conclude that we're not really operating right now with the rates that's set by the Fed. The Fed funds rate about 3.5. Even with the mortgage rate at 6.5, I do expect mortgage rates to come down, but we're not operating in a restrictive environment at all.
I don't think so. I don't think so. I mean, even if you look at the 2-year, a shorter term rate, a little longer than Fed funds, which is overnight, but less than 10 years, the average for 2-year treasuries is around 3.7%. Right now, we're at 3.9%. So kind of doesn't make much difference where you look in terms of maturities or markets. Interest rates are not particularly high right now. Like I said, people just got addicted to the zero interest rates after the financial crisis, and then again after COVID when they took rates to zero again. So overall, for the last 20 years, the Federal Reserve has artificially pushed interest rates close to zero for roughly 10 of the last 20 years. It's been a terrible policy.
Yeah, and that's why we saw so much money chasing so few goods, especially with the acceleration of that from the global shutdown and the supply shock. That's why the inflation number went through the roof. I remember back in June 2022, somewhere around there, inflation was at 9%. Now it's
Right.
much lower. So great. Let's move on to the second topic, and that is the yield curve. Everybody hears this term, the yield curve from mainstream media, from CNBC and Bloomberg. Again, I always reference those two channels or Yahoo Finance or whatnot. Whatever you watch, that's your cup of tea. But nevertheless, the term the yield curve comes up a lot. Dean, why don't you explain to the audience in human terms what that
Right.
is and why is it important?
Right. So the yield curve is, if you think of charting a graph of the treasury rates starting at 6 months, 1 year, 2 years, all the way out to 10 years and ultimately 30 years, you normally have an upward sloping curve, an upward sloping line where longer term interest rates are higher than short term interest rates. And that makes sense. You should, as a lender, you want to be compensated more for lending money for a longer period of time.
And that's
That's
normal.
that's
That's normal.
normal.
Yeah. Hmm.
What happened for quite a while post COVID is that the yield curve got inverted, which means that short-term rates were higher than long-term rates. And inverted yield curves really have negative effects on the financial system because it upsets the general mechanics for how banks and financial markets operate. Banks, in particular, borrow money on a short-term basis from a lot of depositors, and then they lend it out on a long-term basis to corporations and mortgages and things like that. When the yield curve is inverted, it's very tough for banks to make money because they're earning less on their assets than they're paying to depositors. Since in the last year or so, the yield curve has re-steepened. So long-term rates are now well above short-term rates. And that is generally a positive sign, but it also includes an effect for inflation, because if you're going to have inflation that's running above, say, 2%, which is the Fed's target, that also needs to get built into longer term interest rates. And so watching the yield curve gives you a really good sense of where financial pressures are, where inflation expectations are. It's a really important indicator. And when it acts in an abnormal way, when it's inverted or if it's very flat, that's a signal that something's not really working well in financial markets. Right now, it's much steeper than it had been. And that says to me that the financial markets are in pretty good shape.
Yeah, that's nicely put. I appreciate your explanation. So basically, the yield curve is very much as an indicator of how the economy is going to do. It's almost like a little crystal ball. I wouldn't say crystal ball, but it's a tool for us to see what are we going to expect. So an inverted yield curve where the short-term rates are higher than the long-term rates, that is a prelude to a recession. So I've been told. And
Often, it very much is
right.
an indicator. Now, we didn't get that this time.
No.
And there's a lot of reasons why
Yeah.
things didn't go according to plan. That's probably another conversation we can
Yeah.
have. But right now, the basic economy is doing pretty well. The labor market's doing pretty well. The big concern that is over at the Fed right now is and should be focused on inflation and the
Yeah.
risks that it can reaccelerate. And part of that is attributable to energy prices from the war in Iran.
Yeah. So we did experience a period, a short period of an inverted yield curve. But in my opinion, is that due to the COVID situation, that the labor force was so tight. Many
Right.
corporations were overhiring. They're chasing after human capital. So the last component, the last piece of the puzzle that we can officially call it a recession, because we did have 2 consecutive quarters of
Right.
negative growth for the nation. But because corporations were basically chasing after overhiring, that caused a tight labor supply situation, and therefore we didn't call it officially a recession. But anyway,
Right.
fast forward to today, the economy is growing much, much better. We have this, obviously, this AI infrastructure bill, capital expenditure from the corporations are spending their money for good reasons because they're building out the future for us, right? We have had a rolling recession already. So I really don't foresee a recession coming. I actually see a nice growth period that we're in right now and also in the near future for the US. And that lead us to winners and losers. In every situation at any time, there's always going to be winners, there's always going to be losers. And what do you see currently as opportunities right now in the bond market? So for bond investors, what type of bond investments would you take a look at now? And then what are some of the risks that you see?
Right. I think the main point to make with respect to people investing in bonds is you have to take a much more tactical, active focus than you did in years past. So for many years, the standard rule of thumb was a 60-40 allocation, 60% equities, 40% bonds. When one went up, the other went down, and that was a pretty solid relationship. That relationship has broken down. And bonds, in particular longer-term bonds, are moving in concert with the equity markets. And so it has been useful to reduce the amount of exposure to longer-term interest rates, something that people in the market call duration. But you want to keep the maturity of your bond holdings generally shorter rather than longer. And that means you're not buying 30-year treasuries. You're not buying very long corporate bonds. You're trying to keep your interest rate exposure reduced because interest rates are still quite volatile and you're simply not getting paid enough to take that exposure. So keep your duration short. The second thing is that people used to take a perspective of, with my bonds, I'm just going to fund it and forget it and not really look at that over the medium term. And that is no longer viable either. You need to be much more tactical. You need to be looking at relative value across sectors. Now, that's not something that retail investors can necessarily do very easily. And one product that we manage that you mentioned earlier in the conversation, the FIXP product, does that for you. And there are other exchange traded funds. I'm not saying we're the only ones that do that. But what it does is it looks at all of the sectors of the bond market, from corporates to high yields to municipals and so forth, mortgages, and it tactically allocates across those sectors based on a lot of different factors, and probably more detail than we need to get into right now. But that kind of tactical approach, a little more actively managed in your bond portfolio, making it more like your stock portfolio, where you're not just sort of buying and forget about it, we think is something that's really essential in the current environment.
So yes, stay vigilant, stay tactical. The landscape can shift, but in my opinion, I still believe there are a couple of cuts down the road, even though that we might go through a long pause. The Fed doesn't really need to rescue the economy, so to speak. And so with that, I'd like to conclude, this week's show with Dean. It's always a pleasure to have you, the expert in the fixed income field. If you liked the video, please hit the like button and subscribe. And I will see you.
The views expressed on Edible EconoMIX are for informational purposes only and do not constitute an offer to buy or sell any securities. Market conditions can change without notice, and past performance is never a guarantee of future results. Investment involves risk, including the possible loss of principal. Andrew Tang and Turner Financial Group Incorporated do not provide tax, legal, or accounting advice. You should consult with your own professional advisors before making any financial decisions. Turner Financial Group is an SEC-registered investment advisor. For more information, please visit advisorinfo.sec.gov. Advisory services are only provided where properly licensed and under a formal client service agreement.